Good afternoon. Time to check in on the markets. Global markets weaker for a second day in a row as a nearly $1 trillion weekly wipeout in your top tech earnings. Rather, top tech stocks outweighing the hopes that we could see a slowdown in ECB and Fed interest rate hikes, as well as the fact that the U.S. economy is not in a recession just yet. U.S. GDP coming in higher at an annualized 2.6% for the third quarter, higher than the consensus of 2.3. When we look at what's happening in Europe, markets on that side lower as investors digest the interest rate decision by the European Central Bank, increasing their interest rates by 75 basis points. Over on the Asian side, we had Hong Kong leading the losses as the Bank of Japan maintained its benchmark interest rates. Locally, all share index weaker, down by nearly 1.25%. But to wrap up the week that was in terms of some of the key themes and analyze U.S. earnings season for us, we are joined by Thato Mashego from Sanlam Private Wealth. Thato, thank you so much for your time. Given the global market picture that I've just described, how would you, describe the sort of market sentiment that we're seeing right now?
Good afternoon, Nastasia. I would say that market sentiment has been a bit volatile. Yesterday, we saw somewhat of a risk on trade when the US GDP figures were initially released, as well as an announcement from the ECB. But today, following some of the tech earnings that have come out, in particular Facebook and profit warning from Amazon, we've seen somewhat of a reversal. If one looks, for instance, at the US third quarter GDP figures, the headline figure is quite positive at 2.6% year on year, which brings the figure for the year in total to about 0.8%. However, if we look at consumer spend, it's only at 1.4% for the quarter. And stripping out trade as well as inventory restocking, GDP only grew at about 1.5%. So clearly there's evidence of slowing momentum in the US economy, and a lot of people predicting that next year we're likely to see significant softening as well. So the US 10-year yield is now above 4% again, whereas it was at 3.9% yesterday. So a bit of a risk-off trade in that sense.
So I mentioned in my intro, Bank of Japan maintaining its dovish policy and keeping ultra-low interest rates. What's the implication for that?
Well, Governor Kuroda has persisted with the dovish stance, and real yields in Japan still negative, whereas in Europe, thanks to some of the monetary tightening from Madame Lagarde, we're seeing positive real yields at the moment. The reasoning, I suppose, is a bit multifaceted. Of course, Japan has for the past 20 years struggled with deflation. And so suddenly having inflation above the 2% benchmark rate with the run rate at 2.9% at the moment is somewhat of a change, and a bit of a welcome change in terms of longer term monetary dynamics. However, of course, the yen has depreciated significantly as a result of the differential in rates with the US dollar. So 22% depreciation so far this year. I think it's trading at around 148 to the dollar at the moment. So obviously there's a bit of importing of inflation, and that does impact consumer outlook. However, real wages are not yet growing, and so the bank feels that some of those inflationary pressures are not quite entrenched. So my view is that they will continue with their dovish stance. They are not overly concerned with inflation, being just slightly about 1% over their target rate doesn't impact long-term inflation expectations. And of course, you would remember that in 2007, they were also late to the party, but they decided to start hiking rates just as the economy was starting to lose momentum. So again, with the view that next year we're likely to see recession in major parts of the world, they don't feel this is the time to start hiking rates right now.
So let's move things stateside. We all woke up to the news that the Elon Musk Twitter deal is completed. I mean, what questions does it raise for you around the future of Twitter?
Well, I suppose the easiest part of that answer would be that Twitter, of course, is now a private company with the $44 billion transaction complete, shareholders getting a price of, I think, $54 per share. Of course, Mr. Musk does feel that he is somewhat overpaying. There was a bit of a legal battle, and he wasn't able to lower that price. And the relationship that he had with the prior CEO, Mr. Agrawal, obviously deteriorated. So it's no surprise that he has let Mr. Agrawal go as CEO. He's also fired many of the execs, including the CFO and the legal counsel. So he will bring in his own people. He's rumored to have asked Tesla engineers to review Twitter's code in the meantime. In terms of his plans, there is obviously the mooted staff cuts. Some have suggested up to 75% of Twitter staff could be let go. In terms of running the company, I don't think it will have a significant impact. If one considers WhatsApp, at the time where it reached 1 billion users, it had somewhere between 2,000 and 3,000 employees, whereas Twitter has 200 million users and 7,500 employees. So just from that perspective, I don't think it's tremendously impactful in terms of the running of the business. Obviously, some people feel that Mr. Musk's views with regards to free speech may impact some of the, I suppose, the way that Twitter is managed longer term. So that is more of a social dynamic, and what that means in terms of reversing lifetime bans for individuals such as former President Trump, that may have other social implications going forward as we look to the 2024 elections in the US. But from a business perspective, I think his view is that he want to obviously boost revenues, cut costs, and perhaps relist it at some point in the future.
Tato, let's leave it there. I would have loved to talk to you about US earnings season. However, we'll leave that for another time. That is Tato Mashego, who is a portfolio manager at Sanlam Private Wealth, wrapping the week up for us and then touching on the implications for the future of the Twitter platform. That is it from me. We're going to take a quick break. When we come back, we'll have SME on point, so stay tuned.